Welcome to Co-Founder Chats. My name is Ryan Correa, and I'm joined today by my co-founder and in-house expert, Alexander Morsink.
Good morning.
We run Equivesto, a Canadian online investment platform, and today we're discussing SPVs. Okay, getting right into it. Alex, what is an SPV?
So, Ryan, an SPV is a special purpose vehicle, but essentially a special purpose vehicle is a separate company or entity created for one singular purpose. In the sort of startup and investing world, typically an SPV is created for the purpose of gathering a group of investors to then invest as one entity into a company. Typically, SPVs are almost like miniature funds in the sense that they often use a limited partnership structure, but they certainly can also be set up as corporations, depending on the purpose. But in the startup funding world, they're typically like a miniature fund. The name special purpose vehicle makes us think that there's something special or unique or different about it that
Right.
we may not realize or recognize, but really it's just you're creating a totally separate legal entity, and then everyone will invest into that legal entity, and then that legal entity is what will then invest into the company.
Okay, and what is it kind of widely used for? Is it just specifically only for private investments? Can it be used in the public markets? Like what is it used for?
Basically, any time where you want to create, if we're being very broad and we're looking at the broadest use of the word special purpose vehicle, it really will be for any scenario where you want to have a separate company or a separate entity for one singular purpose. For example, if you had a corporation, a large corporation, a
Mhm.
multinational corporation, you could create an individual subsidiary company, which would be a special purpose vehicle just for investing into one startup. Or you could create a special purpose vehicle to develop a new sort of in-house product. But in the sort of startup and investing world, it's typically just used for gathering and grouping smaller investors so they can then invest as one larger investor into a company.
How does the structure work for SPVs? Because it seems quite complicated from what you described so far.
Yeah, it's a great question. If you have any experience setting up limited partnerships before, an SPV is going to be exactly like that. So the standard SPV structure in Canada is going to be a limited partnership agreement. So a limited partnership is a type of legal entity. It's a type of business entity. It's like a corporation where you have essentially, rather than a group of shareholders who own shares of a corporation, the corporation being a totally separate legal entity, a limited partnership is a partnership between a group of individuals, one or a few individuals being the general partners, which is the individuals responsible for managing and controlling all of the funds of the entity, and then a bunch of limited partners who essentially are the investors, the individuals who put up their money, and they don't really have much role in actually running or managing the day-to-day operations of the vehicle. The main thing to keep in mind about partnerships, where they're different from corporations, is a corporation automatically limits people's liability. So all of the shareholders, they've invested into the corporation, but the liability is held directly by the corporation itself. It's a totally separate legal entity under the law. Whereas with a limited partnership, the liability flows through to the partners. The limited partners are limited in their liability. That's why they're limited partners. And their
Mhm.
liability is just the amount that they have invested into the partnership. So, for example, you put in $100,000, things go south. The maximum that you could ever lose is the total amount that you put in. The general partners, on the other hand, the liability extends to them personally. And so, if you were a named individual general partner and something went wrong with the partnership, technically that debt would follow you all the way to your personal assets. Now, with the setting up of most limited partnerships, the general partner is typically a secondary creation. It's a numbered company. So now it's a corporation created solely for the purpose of being the general partner of this limited partnership. And then the individuals who are the directors of that general partner or the shareholders of that general partner corporation, they would be the ones actually managing the limited partnership. So it's a little bit long-winded, but basically the setup is the exact same as any other sort of private investment fund, set up as a limited partnership with general partners controlling the money and limited partners investing the money into it.
Yeah, and that seems super useful for investors, of course, for the limited partners, for less work on their side. Their roles and responsibilities seems much much less than investing directly. But I guess what's the usefulness on the company side? Why would they want to enable and allow SPVs to be invested into their business?
Yeah, so from a company perspective, as you're starting to scale and raise capital, there are certain scenarios sometimes that you might want to avoid. When you're raising capital and you're much smaller, you're often looking to bring in friends and family and angel investors who aren't writing massive $1 million checks like VCs might. In that scenario, to help keep your cap table clear and make management of those smaller investors easier, you might prefer to have people investing under a certain check size all pooled together into an SPV, so that on your cap table, you only have larger investors and then one SPV representing all of the smaller investors. That can certainly make that investor management piece a little bit easier if the individual, typically a lead investor controlling the SPV, then would manage the contact and communication with all of the smaller investors. Even if you did want to keep that relationship with each investor direct to yourself, which you certainly can, having fewer investors on the cap table can be a benefit when looking to raise in the future from larger investors like VCs or private equity firms, as from their perspective, it does mean, there are fewer cooks in the kitchen. You can avoid this if you are offering smaller shareholders non-voting shares and you have a voting trust and they're in a separate share class. So that's another great alternative. It really just depends on, the way that you want to structure and set up your business.
So now I'm a founder, I've raised through an SPV. What happens in the long run? What is my sort of role and responsibilities moving forward?
So if you're the founder of the company and somebody else is managing the SPV, then that individual, whoever's managing the SPV, is the representative of all of the investors who came through that SPV. So essentially, you're just communicating with that person as if they were one investor, giving the standard sort of updates, communication, and details to that individual, as is their right as a shareholder in your company. That individual is then responsible for going out and managing all of these smaller investors in the SPV. Now, if you want to have a more active role in communicating with every investor in your business, including those who invested through the SPV, then you could add all of those individuals to your investor communications and everything like that. It is important to note, though, that because those individuals invested through the SPV, it's not the same as if they invested directly. For example, if one of them decides all of a sudden, okay, I need to exit, I need to get my money back out, it's not that they can just take their money out of your company directly, because they didn't actually invest in you. They invested in the SPV, which has specific rules and restrictions around what happens to those funds. And then the SPV invested in your company directly. So you need to keep that in mind a little bit much further down the road. In terms of what happens when there's an exit, when the company gets bought or you IPO or something like that, just like with any other investor, at the moment of the exit, when everybody's getting paid out, all of the money that would go and had been invested and would be returned to the SPV goes directly to the SPV. And then the SPV itself will have its own rules around how that money is split up and repassed back to the underlying investors.
Who can invest in an SPV?
SPVs are, again, limited partnerships. And so they're going to have their own rules and restrictions around capital raising. So in Canada, if you're going out to raise capital as a private business and you're not specifically setting up that business to raise from the general public, so you're not using the offering memorandum, you're not using equity crowdfunding or something like that to allow the general public to invest into your business, then it's going to be, you as a business will only be able to raise from friends and family, high net worth investors called accredited investors, or a new category of investor called the self-certified investor, which is essentially investors who have passed certifications or have the minimum required knowledge to invest in higher risk startups. An SPV is a private company just like you. So if it hasn't done any special additional paperwork, is going to face those same restrictions: friends and family, accredited investors, and self-certified investors. However, if you want to go through the work of actually setting up, for example, an equity crowdfunding round, you can equity crowdfund directly into your company, or you can equity crowdfund into an SPV that flows directly into your company. So it is possible, with a little bit additional paperwork, to make your company and an underlying SPV available for investment to all individuals living in Canada over the age of 18.
I think we talked about a lot of pros of SPVs. What are some shortfalls?
I think one of the biggest thing that is an unknown or not as clear shortfall of an SPV, because people hear special purpose vehicle, they think it's some sort of special side thing that is somehow easier to set up or manage. The reality is, with an SPV, you're setting up a totally separate company, and that company is going to have annual filing obligations, just like your company would. It's going to have tax obligations, just like your company would. It's going to have all of these other sort of annual costs associated with running something like that. So having an entity or paying a little bit extra to have the entity managed by a professional firm can sometimes make things easier. With a corporation, you're going to have sort of annual tax filings. So you're going to have to actually file the corporation's annual report, and you're going to have to file the associated taxes with that corporation. Now, limited partnerships, and again, before I discuss this, I do want to preface, I am not a licensed tax lawyer or an accountant, so this is not legal advice, this is just my personal opinion. Special purpose vehicle handles tax in a different way. So in Canada, limited partnerships are flow-through vehicles. So what I mean by that is they are not a legal entity that pays tax on their own. They pass the tax liability directly through to the underlying investors. So what does this mean when it comes to an investment? Whenever money enters a corporation, that corporation, whether or not they have to pay, HST on that, they're going to have to pay corporate income tax at the end of the year. If they have profits, they pay corporate income tax on that. Flow-through vehicle, like a limited partnership, would not have to pay any corporate income tax of any kind, whether there's a tax liability or there's a write-off, there's a loss, which is a tax benefit. All of that flows directly to the underlying limited partners and potentially the general partner, depending on the paperwork. So what that means is every year, instead of filing a sort of income tax filing like a corporation would, the limited partnership is filing tax forms, but individual tax forms for every underlying limited partner. So the limited partnership has to either work with an accounting firm or do it themselves and create these individual tax forms for each underlying limited partner. Now, if the special purpose vehicle has been created just to invest in a startup where there's no ongoing cash flows until the sort of big exit at the end, all of these forms are going to essentially say $0. And so they're a little bit easier to fill out. But there still are a number of annual tax forms to be prepared. Now, don't forget, the general partner of this limited partnership is a numbered company. And so that company, that corporation, is then going to have its own filing requirements. So it's going to have to complete, an income tax filing and an annual report to the government, just like any other corporation would. So for every year that the special purpose vehicle exists, there's the limited partnership filings and there's the numbered general partner corporation filings that have to be done. There's also an annual meeting that needs to be held by both the limited partnership and the numbered corporation, which is the general partner. So in terms of annual activities to do, even though there's no action that's taken place during the year, there are a fair number of activities that have to be done on an annual basis. Now, when the investment itself is actually paid out to the limited partnership, then of course those annual tax documents do not read zero. And then there's the work that goes into figuring out, okay, what amount of money goes to each person and sort of dividing that all up. And then there's the winding down of the limited partnership itself. So that, again, all takes work at the time that the investment pays out.
So given all that, who are SPVs like not for at all? Like when is it totally not worth to go down this line and simply just invest directly?
So if you're raising capital from only sort of 2 or 3 people, it doesn't make sense to make use of an SPV because that's not enough people, I think, for an SPV to make financial sense, unless as a corporation you have decided we refuse to take checks smaller than $100,000, and the people really want to invest, but they don't make up the $100,000 together, then they may decide to make use of the SPV. But typically the larger number of people you're trying to pool together, the more an SPV might make sense. I think you just need to keep in mind some of these legal costs in terms of setting up and managing the SPV and who you want to be in that role. Oftentimes the lead investor might be managing the SPV, but if the SPV is being set up by the company and there isn't one clear lead investor, then it might be the founders of the company that are managing that SPV. So you just need to keep in mind the responsibilities of who is actually taking on that SPV management and how that's being organized. In terms of why someone would actually want to use an SPV and what's the perspective from an investor. So why would an investor use an SPV? SPVs can help investors invest with a lot more sort of strength and power than if they were investing individually. If you as an individual person with a $20,000 check or a $10,000 check are going to a company to try to invest in them, you're going to be one of their smallest investors potentially. And you wouldn't have much bargaining power to ask for additional information rights or to make sure you're happy with the terms of the deal. You're sort of stuck following along with what other people are doing. But if you and 10 other investors are grouping together and as a combined entity through the SPV, you're investing something like $500,000, then the lead investor of the SPV is in a much better position to negotiate with that startup around things like valuation and terms and other things, especially if there hasn't been a lead investor as part of the round for the startup yet. If the SPV is going to represent that lead investor, then they will potentially set the terms for the full round and take on that responsibility. So as an investor, using an SPV can be quite helpful, but you do need to keep in mind who is actually paying for these costs of setting up and running the SPV. Now, if the company is setting it up, then typically the company would choose to bear the cost of that, and they're offering the SPV because they want to allow these smaller investors and they see the benefit. But if the investor group is choosing to set up the SPV and the company isn't willing to cover that cost, then the investors need to be comfortable with, okay, maybe I'm investing $10,000 into the SPV, but only $9,000 is actually going into the company or whatever it is, whatever the agreed fees are, because I'm willing to pay for this sort of additional vehicle that's going to help me with my investment. That's an important thing to think about. In terms of managing and actually setting up and structuring the SPV, some important things to keep in mind is the cost of, one, creating the limited partnership, which you can't do until you have the general partner. So actually what happens first is the incorporation of the numbered company, which will act as the general partner, and the choosing of who's going to be the directors and the shareholders of that general partner. So the lead investor is typically that person. Next, you actually would create the limited partnership. Now, you don't create the limited partnership until you've actually decided how the limited partnership is going to run and be structured. And for that, you use a limited partnership agreement. So a limited partnership agreement is going to decide how are the funds exactly being used? What are the rights and obligations of the limited partners versus the general partner? Is a management fee being paid to the general partner for their services? All of these sort of things are written out and clarified in the limited partnership agreement. If you don't have a template or you're not basing it off of a standard template, it can cost a fair amount to have a lawyer draft a custom limited partnership agreement for you. And then if we think about those sort of annual costs on an annual basis, if you don't have experience with tax law or accounting, then potentially you'd hire an accounting firm to help you prepare the annual filings for the limited partnership, as well as the annual filings for the general partner. And depending on the number of limited partners in the limited partnership, this can range from maybe $1,000 or $2,000 to potentially closer to like $8,000, $9,000, or $10,000 per year. And so doing this directly without using a firm that helps manage or structure SPVs can become cost prohibitive rather quickly. Now, not to toot our own horn, but Equivesto does offer SPV services, both self-managed, where you're the lead investor and you take on those sort of ongoing annual tax costs, or Equivesto managed, where Equivesto charges more, but also does that ongoing annual management of all of those tax filings. So those are things to consider when looking to set up an SPV. You can also check out Angels List, which is a large national, multinational business that helps startups raise capital, and they also set up SPVs just like Equivesto does. So they're another option that you might want to consider.
What are some of the other considerations or alternatives I can start to use if I'm trying to compare SPVs to what else I can use to raise capital?
Yeah, well, in terms of methods for investing into a company, you're sort of investing directly. You might invest via SPV, or you can invest in a private fund that then goes and invests in the underlying companies. So if you want to invest into startups, but you're not actually interested in even picking or knowing about the companies, and you want to have a professional manage that for you, then you should really consider actually investing into a venture capital fund or some other type of private fund. Venture capital funds are essentially funds. So they're using that same general partner, limited partnership structure, where the general partners are professional fund managers who make it their job to go out, find great startups, and invest in them. The limited partnership agreement for the fund will describe the stage, the size of the investments being made by the venture capital fund, the fees charged by the managers, and all sorts of other details. So you can understand, okay, by investing in this fund, what type of investment exposure am I getting by going in this direction? So if you're interested in taking, you want a bit of a wider approach with your investment, you want to have someone professional manage the investment process, then you might want to consider using a private fund like a venture capital fund for investing into startups. Or if you're looking to invest into real estate, you might want to consider a private real estate fund, something like that, where individuals who are specialized in this area can go and manage that for you.
So where can I find SPVs? I'm interested in them. I'm an investor. I think this is the best method for myself. Where can I find in Canada SPVs?
So if you're looking to invest into SPVs simply as a flow-through vehicle, so again, you're not looking for a fund, but you're looking to invest into a company where it's going to be pooled with other investors, and so you want to participate in an SPV into that company, you can look on a variety of different private investing platforms. So you can look on Angels List, which is probably the largest. You can look on Equivesto, which is our company. You can look on Front Funder, which is another Canadian company that does private investing. And you can look to see if the structure of the deal is set up to flow you through as an SPV. A few other things that you want to keep in mind about SPVs. The first is, based on Canadian law, the SPV is a tax flow-through vehicle only when all the individuals participating in that SPV are Canadian residents. And so when, for example, a company is looking to raise capital and you want to pool those smaller investors, you may have some investors who are interested from the US. If you were to allow those US investors into a Canadian SPV, it would potentially have a negative tax implication on all of the Canadian investors. As soon as you have a non-Canadian investor investing into a Canadian SPV, that SPV is now charged an income tax. Now, again, I'm not a tax lawyer or an accountant, so this is not tax advice. Please speak to a professional regarding this. This is just my opinion, but my understanding is that when you bring anyone residing outside of Canada into a Canadian limited partnership, it loses its tax flow through status. So you would want to be careful when raising to make sure, okay, only Canadians are going into this one SPV. You might consider creating a second SPV purely for US investors if you're going to bring in a lot of investors from the United States, but that's a whole different sort of legal task that you'll want to think about. There's another
Where?
great
Yeah,
point that
go
I'd like
go ahead.
to mention regarding SPVs. A lot of people, before sort of the whole COVID pandemic and right around the pandemic, we're talking about SPACs and hearing about SPACs in the news. So I just want to compare a SPAC and what a SPAC is with an SPV and sort of how they're similar and how they're different.
Mhm.
So a SPAC stands for a special purpose acquisition company. And that's different than a special purpose vehicle. But essentially, a SPAC is almost the reverse of an SPV. So with an SPV, all the investors are pooling together to invest into a company, but the company is known beforehand and in advance. The SPV is structured specifically around the investment into that company at preset terms. So when you're looking to invest into an SPV, in the language of the SPV, in that limited partnership agreement, it should say exactly what company is being invested in, for what valuation, what price, all the terms should be properly outlined in that limited partnership agreement. A special purpose acquisition company is kind of the reverse. So a special purpose acquisition company would typically be set up as a large corporation that is public. So some professional managers would set it up and take it public, list it on the stock market, but the company doesn't actually do anything. It has no operations and it doesn't really have any other employees. And the purpose is individuals can then invest into this, and then this company will find a private company to then acquire. Because the SPAC is already public or is in the process of going public, by acquiring this private smaller company, it sort of automatically takes it public that way. With a SPAC, though, the company hasn't been chosen yet. So you're putting money into something essentially totally blind and waiting for the management team, the professionals, to go out and find a good company to then acquire and take public with the money you invested. Typically, with a SPAC, there's a certain time limit. So if an acquisition target isn't found within 1 or 2 years, the money is returned to you. So again, a SPAC is very different than an SPV. A SPAC is a company that's been taken public already, doesn't really do anything, and is looking to acquire a private smaller company and thereby take it public, whereas an SPV is a private entity planning on staying private, and it's for investing into an already disclosed underlying company where all the terms are already set.
So a SPAC in many ways is quite similar to a venture capital fund, where the underlying company is not determined, but of course, in your instance, you're saying it's going public.
So with the SPAC, I would describe it as more similar to a search fund rather than a venture capital fund. So a venture capital fund is a private entity. Typically, they only last a certain amount of time. So they last 5 years and then they're closed down. And the venture capital fund is really there for these individuals to invest into a wide variety of different private investments and help those investments grow. And then when those investments get sold, the money comes back to the venture capital fund and then comes back to the investors. With a SPAC, you're basically going out, finding a company to acquire, and you're not selling it, you're not exiting it, you're not investing in it, you're buying this company, and by buying it, it automatically sort of becomes public, and then either the managers of the SPAC will hire other people to manage it, or they will manage it themselves. The search fund, which is what I think is the most comparable, is essentially a similar type business wherein an individual sets up a legal entity, they raise some money from investors, and they actually get some money to pay them a salary, and then they go around and look for a company to acquire or invest in. Now, they don't necessarily have to take it public later like a SPAC would. Search funds sometimes stay private, but they're typically used to say, okay, you're someone who's got a lot of skills. We have a bunch of money that we want to use to buy a small business or a startup, but we don't really know which one to buy. We're going to pay you to go find one for us, make sure it's a good one, and then will buy it and you can start running it.
Mhm.
So a SPAC is sort of like the going public version of a search fund.
Okay. So yeah, this sounds like traditional private equity to me. So essentially, I think maybe for the audience, it might be helpful to describe the difference between like traditional private equity, taking a controlling interest in a business versus venture capital, where you're slightly more passive.
Private equity, I'll sort of split into kind of two categories of private equity. So there's one category of private equity firms, and this isn't all inclusive, but this is just for the purposes of this conversation. There's two categories of private equity firms. The first would be a private equity company that's looking to operate companies. And the second would be a private equity company that's simply looking to invest in companies as they scale. So one category of private equity company is focused on finding companies that are private and they specialize in operations. So they're not looking for companies to take public. They want to own a company and run that company for decades, help it make more money, but they're going to be the long-term owners. In this scenario, the private equity company is going to be looking to buy out all existing shareholders and take full ownership of the company themselves. So they won't be actually investing into the company itself, or perhaps not immediately. They're not buying their shares from the company. They're focused on buying out the company. So they would be buying the shares from the existing investors and taking full ownership of the company. Category two of private equity firms are looking to invest in companies and help them go public. So in this category, they're focused on finding later stage startups that have been funded by venture capital. They're going to invest into the company. So they're buying their shares from the company itself. The company is issuing new shares to them. And this influx of capital is going to help the company grow that much more and potentially prepare to go public. Once the company goes public, after maybe a year or two, the private equity firm will then sell their shares and get their return that way. Venture capital firms and private equity firms in the second category are both focused on investing in companies where they put money into the company and the company issues more shares to them. They're not buying out the existing investors. They're not giving money to the existing shareholders to have them leave, and then full ownership of the company goes to either the private equity firm or the venture capital firm. They're focused on joining an existing group of investors and helping the company get larger and larger before everyone has an exit. But the first category of private equity firms that I mentioned, the sort of operating firms, they look to acquire and manage long-term a number of companies. So in that scenario, they're looking to buy out the existing shareholders. Maybe they will put money into the company later themselves directly, but their focus is, I'm going to pay out all the existing investors and take full ownership of the company myself.
Jumping back to SPVs, any final points about SPVs you want to bring up?
I think we've talked about a lot of the great points and some of the drawbacks behind SPVs. I think really if I'm to leave you with one thought about SPVs, what they're really for and the benefit, an SPV is a great vehicle for a startup raising capital who wants to pool all of the investors into one group. So they are represented as a single item on the cap table. From an angel investor perspective, SPVs are helpful because if you invest via an SPV, a lot of smaller investors can pool together and invest with the power and the negotiation ability of a much larger investor. You can use SPVs as vehicles for allowing the general public to invest, like through equity crowdfunding. But that just takes a little bit of additional paperwork and effort in setting it up. SPVs are highly useful, but they are totally separate legal entities. So they do come with their own annual tax costs and costs to set them up and run them, as well as shut them down. So it's important to keep that in mind and weigh the sort of cost benefit analysis of using an SPV with the work involved in managing it. You can certainly make use of one of a number of different companies that help set up and structure SPVs to minimize your cost. And I'd suggest shopping around to find the best option that works for you.
Final question, where can I go for more information about SPVs in Canada?
If you want to learn more about SPVs, Equivesto has a ton of information in our learning center. You can head to equivesto.com/learn, and we outline all sorts of information about SPVs, what's involved in managing them, and of course, the cost to set them up with Equivesto, whether that's self-managed or Equivesto managed. Thanks for a great conversation, Ryan.
Yeah.
I hope you have a good day.
Thanks so much, everyone. Take care.